Welcome back to the channel. My name is Nicholas Coriano, and today we're going to talk about business evaluations. So, whether you're looking to sell a business, buy a business, attract capital, you probably need to know something about business valuations. And in this video, I'm going to go over some of the basics to give you a primer on business valuations. You're not going to become an expert after this video, but you'll definitely understand what to look for, who to look at, and what kind of business valuation methods exist. So let's start with the basics. What is a business valuation? A business valuation is the process of determining the economic value of a business. It's important in case you want to buy a business, in case you're doing mergers or acquisitions, or just making an investment decision, investing in a business. Okay. The main reasons for business valuations are either buying or selling a business, raising capital or attracting investors, or estate planning, taxation, and sometimes in cases, legal disputes. And I have some notes down here that I'm going to be reading through to make sure I don't miss anything in this video. So bear with me here. So key valuation principles are, there's three key valuation principles: fair market value, going concern value, or liquidation value. So the fair market value is what a buyer and a seller agree to the value of the business is, okay? A going concern value is the idea that the business will keep going and keep generating profits, and they're going to base or derive a value off of that. And then we have the liquidation value, which is the value of a business if the assets were sold when the business is going out of sale. Okay, so what kind of valuations do people usually perform on businesses? Usually there's three different valuations. There's an asset-based valuation, an earnings valuation, or earning value valuation, or an earning value approach, and then a market value approach. Okay, so earning value approaches could include like discounted cash flow or past earnings, and a market value approach could include the share price times how many shares there are in the business. So the main factors that influence business value is financial performance, market condition, and industry trends. Those three things in general can give you a fair valuation of the business. Um, Sometimes people use professional valuators or business valuation firms. There's a few of them out there. On the bigger end, you have Deloitte, McKinsey and Co. On the smaller end, you have a ton of guys with MBAs that are consultants online. We do business valuations at Servitude. Um, if you're looking to get a valuation for the sale of something, it's always good to get a third party valuation. That way, at least it's not biased, even though insider secret, right? Usually the person paying for the valuation gets what they want. So if they want a low valuation, let's say they're getting a divorce and they don't want to give their significant other, property, they usually try to value it lower, and if they're looking to sell it, obviously they're looking to value it higher. But professional valuators do exist, and it may be to your advantage to hire one depending on your scenario. So, some of the common misconceptions about business valuations, and then I'm going to get deeper into some of these specifics. Some of the common misconceptions are valuations aren't exact science. They're not, they're kind of an art. My business is worth what I think it is, right? A lot of people go in and say, I think my business is worth that. Well, a valuation can either prove that right or wrong, but generally your business is worth what somebody's willing to pay for it. So, and then valuation doesn't matter unless I'm selling. That's not necessarily true too. Sometimes it matters if you're mortgaging the company or raising capital. But valuations do matter. So let's talk about methods of business valuation. So the first method I want to talk about is the asset-based approach. There's a couple valuations here that you can use when you talk about the asset-based approach. One of them being the book value approach, the next one being the liquidation value method, right? So the book value approach really takes the book value of all the assets, adds them up, subtracts the liabilities, and it gives you the book value, right? Liquidation value is very similar, except it accounts for the fact that you're going to liquidate all of the assets, meaning you need to get rid of them today, which usually kind of brings the valuation method down. And it gives you a lower valuation method on the liquid value method. But those are two approaches that a lot of people use. Generally, when they're trying to get a lower valuation, or more reasonable valuation on the actual assets of the business, they try to look for a book value of the business. Warren Buffett was a big proponent of the book value of a business. because he said, hey, look, if this, if the company is trading at $20 million and the book value is, $25 million, then it's a deal, right? Because you're essentially buying a $25 million business for $20 million. And if you had to sell off the entire business, you would get $25 million, but you bought it for $20 million. So that's the asset based approach. The second approach that I want to go over is the earning value approach. This gets a little more convoluted, and I'll give you some key buzz terms to look up after this video. But generally, what you're looking here is at earnings. So there's two ways to do it. There's the capitalizing past earnings, and then there's a discounted cash flow, which kind of looks at the future earnings. Okay, so in capitalizing past earnings, the business values equals the earnings divided by the capitalization rate. Okay, and in the discounted cash flow method, right, it's you're calculating the net present value of the future earnings, the net present value of the future earnings. Now, don't have to get too crazy into this. There's a lot of calculators out there that will help you with the discounted cash flow. But a discounted cash flow is an estimate value of an investment using the expected future cash flow. So basically what you're doing is you're saying, look, this thing is going to keep spitting out, $1 a month or $100 a month, and that $100 a month over the next 2 years, 3 years, 4 years, 5 years is worth X amount today, right? That's the discounted cash flow method. And capitalizing past earnings is very similar, just in the reverse. It's basically measuring, saying, look, it gave us instead of it's gonna give us $1 a day, it gave us $1 a day, and we're gonna project out, and we think that it's worth this much today based on what it gave us already. Again, the different approaches, one is going back in time, one is looking into the future, but both are giving you the present value of the business based on that approach. And that's the earning value approach. The next is the market value approach. And for the market value approach, market value is usually what a buyer will buy it for, right? This is pretty good in real estate. A lot of times they use this market value approach, and they do a lot of comparable analysis here. So in companies, they do comparable company analysis. So what do other comparable companies sell for, or what have they sold for? In real estate, right? What do other real estate deals that are similar sell for? And then look at the transactions that have happened in those deals, and that gives you a good idea of the market value approach. Okay, so how do you choose the right method? Well, it all depends on what you're trying to do, right? If you're trying to get the number higher, you're going to choose a certain method. If you're trying to get the number lower, you may choose the asset value method. If you're in a certain industry, certain methods may be better than other methods. So it really depends on the industry, what kind of valuation you want, how much time you have to do the actual valuation, and so forth. Sometimes you can use multiple valuations. You don't have to use one. I've seen valuations where they use all of the valuation methods, right? And you kind of get a synopsis of this is the liquidation value, this is the discounted cash flow value, this is the market value of the business, or the investment. So make sure that when you're putting together your business valuations, all business valuations should be adjusted for risk. Um, Important risk factors could be, CEO risk, like for example, management risk, right? So if the business is closely tied to the know-how of the management, that's a risk, right? Or geopolitical risks, or environmental risks, or market condition risks, right? So if you're in a market that's fluctuating highly, whether it's a technology market or a geographic market that may have some issues, you want to adjust your valuation for those risks, or at least put in a denominator there that will adjust it for the risk. So commonly used multiples when you're talking about the business valuation. So once you come to a valuation, sometimes what they do is they try to sell you on a multiple. PE ratios, EBITDA multiples are ways that you can apply these to your valuations to give them a higher valuation. Usually for PE ratios, which is a price to earnings ratio, you're looking at comparable companies and seeing what they sell for. So, for example, let's say you're in manufacturing and you look at other manufacturers in your field or industry or sector or geography, and they're all selling at a 3 or 4 multiple. Then your business may be valued at 3 or 4 multiple. Meaning, if the valuation says, look, we make 100,000 profit a year at a 4 multiple, that means the business would be valued at 400,000. Right. So if you pay 400,000 for the business, in 4 years you're going to make back that money. Another multiple is the EBITDA multiple, earnings before interest, taxes, depreciation, and amortization. Again, some of these keywords you should probably look up or at least put into, there's a lot of financial calculators that'll do some of these things for you. But just keep those in mind for valuation methods, because once you have the value of the company, or what, projections wise, what you think it'll make next year, then the idea is how much are you willing to pay for that, right? You're probably not going to pay the exact amount. You're either going to pay a multiple of it, or a multiple of less if it's declining. Very pretty rare in situations. So the whole purpose of a valuation report is to make an informed decision on your investment, whether you're buying or selling it. So just keep that in mind. So some of the tools and resources, like I said, there's a lot of software out there. BizEquity has a software, Value Adder has a software, and they look at financial statements, balance sheets, income statements, cash flow projections, and they kind of put all of that into the mix when putting together your valuation. So there is valuation software out there. Financial statements are really the key to most valuations. Um, in most cases, sometimes in stock analysis, not so much, but generally in stock analysis, the same thing, right? Most of the time, it's your cash flow statement, your income statement, your balance sheet. Those are the three things you want to focus on with business valuation. By the way, this is whether you're buying a business privately, right, or whether you're just buying a stock in a company, which is almost the same valuation, except stocks usually have additional valuation concerns. But your cash flow, balance sheet, income statement are the key critical pieces to business valuations. They're important to create accurate business valuations and key financial metrics for your valuation. So make sure that you have at least those statements. And if you're running it through software, that's great. If not, understand those statements. IBIS World and Statista also have great, these are research portals that have great data on industries. This is great for comparable research. If you're looking to compare it to other companies or other industries, or see what the macro industry is doing, or a micro geographic industry is doing, the Census Bureau has great data as well. Discounted rate calculations and calculators. So we talked a little bit about the discounted rate for valuating. There's calculators out there all over the place. So if you type in valuation calculators online, you're going to find a lot of them. Those are great tools. And then professional valuation services. There are firms, small and large, that do professional business valuations. If you don't have the time, or it's cumbersome, or you need a third party. Sometimes you need a third party to give you a view that's not so biased. Let's say you're buying a business, and you love the business, you love the sector, you love the industry. You don't think you're going to be biased when creating the valuation. Uh, have a third party do it. There's a lot of professional valuators out there that are more than competent. And then, of course, there's books, resources, online tutorials, YouTube videos like this one that you're watching now that can help you. So, to wrap this up, I want to go over some of the best practices and common pitfalls when it comes to business valuations. Business valuations, the first one that I'm going to start with here is business valuations really rely on data. So, if you don't have good data, you're going to get a bad valuation. If you don't have accurate financial records, so that's the first key tip. Keep accurate financial records, or get accurate financial records to create an accurate, up to date business valuation. So they should be accurate and they should be up to date. Regular updates or audits on a business that you're running, buying, or selling are important when creating a great business valuation. Avoiding overvaluation or undervaluation. Most of the time, this comes from incorrectly calculating risks, being biased, or strategies to achieve accurate valuation can include just encompassing all of the valuations. If you put all of the valuations together, generally you're going to come up with a happy medium, and you're going to see exactly where the proper valuation should stand. Remember, there's no blanket statement here, right? The right valuation is going to be what somebody's willing to pay for it. You're doing this though in advance of that. So in advance of that, to avoid overvaluation or undervaluation, try to go through as many valuation methods as you can. And that way you get a nice range of where your business is supposed to be valued at. The third common pitfall is people don't consider non-financial factors. So I talked a lot about financial factors, but there's an impact to, let's say, the brand, right? Or customer loyalty or market position or management functions, right? Or key personnel. All of these things can impact the valuation of a business. If you bought a business and it relies heavily on key personnel and that key personnel leaves, it's going to significantly impact the value of that business. If you have a business that has a strong 100-year brand and you don't factor that in, Coca-Cola is a great example of this. The goodwill on Coca-Cola's trademark and on their business valuation is super high, right? You're getting a bigger valuation that. So a lot of people miss that. They go right into the numbers, but you have to, the impact of the brand, customer loyalty, key personnel and market positioning, geographic positioning, all of that matters, including intangible assets in the valuation, right? So keep that in mind when you're putting together a business valuation. A professional valuator will put a weight on those things, and they can adjust that weight usually in an Excel file to give you a proper valuation. The next thing that people miss is communication with stakeholders. So, explaining the valuation to buyers, investors, sellers, or transparent communication between buyers, sellers is important to business valuations. A lot of times, people go into a business valuations, they just want to see the books, but the books don't always tell the whole story. I've talked to a lot of business sellers and business buyers where the experience is that they go and read the books, and then later on, they find out that the books were cooked in some way. And I don't mean that in a malicious way. I mean that, maybe they had a car that they personally used on the balance sheet that they took out once they bought the business, or that they were running, their living situation on the cash flow statement, and that now came in or out of the business valuation after it was purchased or sold. So clear communication with the stakeholders, investors, business owners, employees is important to kind of uncover those little nuances in the financial statements that may not otherwise be apparent when reading the financial statements. Um, Regular valuations. This is another common pitfall. It's important to do regular valuations for a business. The benefits of a regular valuation is that you're always ready to sell if you're ready to sell it, right? And you're always ready to buy if you're going, take out a bank loan, or get an investor, someone understands the value of your business. So the second, the sixth most common pitfall is not documenting the valuation process. Like I said, there's all these nuances in the valuation process, and every single detail should be uh, recorded, right, and documented so that the person reading the valuation understands how you came to that conclusion. And then the last pitfall that I've seen people make is they don't understand that you can learn from the valuation reports, right? They kind of just want a conclusion, but valuation reports are really, kind of a learning guide. And you can analyze past valuations to improve future accuracy, and you can use those valuation insights for business strategy. So that's one of the best, workings of business valuations, other than investment purposes, is really to understand how to move forward, with or without an acquisition, with or without a merger, with or without a purchase of an investment. So that's the primer today on business valuations. I hope you learned something. There's a lot of key words in here that you may not have understood. Please look them up. They'll help you with business valuations, business strategy in general. If you need a business valuation, reach out to our firm. We can definitely help you. I have the link in the comment section below. And like this video, share the video if you thought it was helpful, and I'll catch you guys on the next video.